For entrepreneurs, the decision to raise capital is a critical one, often fraught with uncertainty and risk. It can be a catalyst for growth, but also a burden in case not timed correctly. Understanding when to seek funding is as crucial as knowing how. This video delves into the key factors entrepreneurs should consider when contemplating raising capital, helping them navigate this complex, yet many a times essential aspect of business. What are the fundamentals of raising capital? Before diving into the timing, let's briefly understand the fundamentals of raising capital. Why raise capital? Capital injections can fuel growth, fund research and development, cover operational expenses, launch new products, or acquire other businesses. What are the types of capital? The first is equity financing, which involves selling ownership shares in exchange for funding. The second is debt financing. This refers to borrowing money with the obligation to repay with interest. The third is bootstrapping. It is self-funding through personal savings or revenue. The fourth is grants, which are non-repayable funds from government or non-profit organizations. Now, what are the sources of capital? The first, angel investors. They are high net worth individuals who invest in early stage companies. The second is venture capitalists or VCs. These are firms that invest in high growth companies. Third is banks. These are traditional lenders offering loans and lines of credit. The fourth is crowdfunding. It involves raising small amounts from a large number of people. So, what are the key timing considerations for raising funding or capital? This depends on factors such as the stage of business, market conditions, business traction, financial needs, as well as the team and expertise. Let us analyze each factor individually, starting from the stage of business. The first is the idea stage. It's generally too early to raise capital at this stage. Focus on refining your idea, building a prototype in case applicable, and validating your business model. The second is early stage, which is seed. This is when you may seek seed funding from friends, family, or angel investors to get your business off the ground. The third is growth stage. In case your business is showing traction and you have a solid business plan, you can approach VCs or other investors for Series A funding to accelerate growth. The fourth refers to later stages. Subsequent funding rounds, such as Series B, C, and others, can be raised to fuel further expansion, enter new markets, or prepare for an IPO. Now let us review market conditions. The first is economic climate. A strong economy with investor confidence is ideal for raising capital. In downturns, investors become more cautious, making it harder to secure funding. Second is industry trends. If your industry is booming, investors may be more willing to invest. However, competition would also be higher. The third is interest rates. Lower interest rates make debt financing more attractive, while higher rates can make equity financing more appealing. Next is business traction. First, the revenue element. Demonstrating consistent revenue growth is a strong indicator of potential success and making your business more attractive to investors. The second point is customer base. A growing customer base validates your product market fit and signals demand for your offering. Third is key milestones. Achieving significant milestones. Example, launching a new product or securing a major partnership can increase your appeal to investors. Now let us evaluate financial needs. The first is burn rate. Understand how much capital you need to cover your expenses before becoming profitable. The second is funding gap. Calculate the difference between your current funding and the amount needed to reach the next milestone. Third is dilution. Be prepared for the potential dilution of your ownership stake when raising equity financing. Finally, moving to team and expertise. First, experienced team. A strong and experienced team can instill confidence in investors. Second element is an advisory board. Having advisors with relevant industry expertise can add credibility to your business. Let us understand the scenarios as to when to raise capital. 1. When there is a clear path to profitability. In case your business model is proven and you have a clear path to profitability, you may consider raising capital to accelerate growth. The second is market opportunity. If you identify a significant market opportunity with limited competition, raising capital can help you seize it before others do. The third is cash flow needs. In case you are running low on cash and unable to secure traditional financing, raising capital might be necessary to avoid shutting down. The fourth element is strategic expansion. If you plan to enter new markets, acquire competitors, or invest in R&D, raising capital can provide the necessary resources. When not to raise capital, let us examine these points. The first is unproven business model. In case your business model is unproven or you haven't achieved product market fit, raising capital may be premature. Focus on validation first. The second point is lack of clear plan. Investors want to see a detailed plan outlining how you utilize the funds and achieve the return on their investment. The third is unfavorable terms. Do not accept unfavorable terms to get funding. It could hurt your business in the long run. The fourth is personal reasons. Don't raise capital solely for personal gain. It should be aligned with your business goals. The decision to raise capital is a pivotal moment for any entrepreneur. Timing it right can mean the difference between success and failure. By carefully considering the factors outlined above and aligning your funding strategy with your business goals, you can maximize your chances of securing the capital you need to achieve your vision. Remember, raising capital is not an end in itself, but a means to an end. The ultimate goal is to build a sustainable and successful business. With careful planning, strategic timing, and a focus on creating value, you can leverage capital to propel your entrepreneurial journey to new heights. Thank you very much for your time.